You understand balance sheets and you've studied technical patterns. Yet, despite the work, you're consistently losing money in the market. The gap between your knowledge and your results comes down to a missing third pillar, mental analysis. To bridge that gap, we're going to apply the core concepts from Mark Douglas's framework, Trading in the Zone. By the end of this video, you'll have a physical, 5-step pre-trade checklist. This system is designed to strip fear and greed out of your execution process entirely. Grab a notebook and a pen right now. From this moment on, make it a hard rule. You do not enter a single trade until you have filled out this checklist. Cultivating this specific, disciplined mindset separates emotional gamblers from the highly disciplined investors who secure returns over the long term. Step 1 is establishing your mental baseline. Write down your specific trade setup and make sure your reasoning relies strictly on objective technical indicators or fundamental data. Now, pause and do a mandatory emotional check. Ask yourself honestly, are you entering this position out of a fear of missing out, a sudden urge of greed, or does the actual data support the entry? Here is the absolute rule for this step. If the urge to trade is driven by emotion, you must stop immediately. You only get to proceed if your logic perfectly aligns with your pre-established trading plan. Physically checking off this first item forces your brain to pause. It requires you to recognize your own subconscious biases before a single dollar is actually put on the line. Step 2 is quantifying the worst-case scenario. Write down the exact maximum monetary amount you are willing to lose on this specific trade. Look at that number and ask yourself, if I lose this exact amount, will it ruin my day, either financially or emotionally? If your answer is yes, your position size is objectively too large. You need to reduce your stake until the potential loss feels manageable before you move forward. Professional trading is a business of managing accepted risks, where success is defined by how well you follow your parameters rather than how well you avoid market volatility. Truly accepting the potential for loss replaces the urge to panic with a clinical observation of the trade's progress. Step 3 moves from risk to reward. You need to define and write down your exact exit price for profit right now before you even open the position. Market volatility triggers two dangers. Overconfidence tempts you to hold a winner too long, while sudden fear pushes you to sell it too early. The market is entirely indifferent to your personal hopes or expectations. That means your profit target has to be locked in logically, based strictly on previous chart data and structure. This chart visualization shows exactly how your boundaries should look. By predefining a strict upper take-profit line and a lower stop-loss limit, you cut off any opportunity for mid-trade emotional manipulation. Step 4 requires a shift in perspective. At the top of your page, write Trade 1 of 20. We are going to stop evaluating your success based on a single outcome. At its core, trading is a numbers game. As long as your strategy is sound, the specific sequence of individual wins and losses simply does not matter. Look at this 20-trade grid. You might average 12 winners and 8 losers. The results scatter randomly. You can't know if the next trade is green or red. But individual losses become irrelevant because your system's statistical edge pulls the overall equity curve upward. Thinking in blocks of 20 destroys the psychological pressure that every single trade must win. This perspective is the defining characteristic of the zone. Finally, step 5 is the mechanical execution. Open your trading application and execute your buy order exactly as outlined in your confirmed setup. Follow that immediately with the simultaneous entry of the hard stop loss from step 2 and your limit sell order from step 3. Do not leave the orders open. Now for the most difficult behavioral rule of the entire system. Step away from the screen entirely and let the market do its job. You will feel a dangerous urge to manually modify or cancel your automated orders because of mid-trade anxiety. Resist it. Strict automation serves as a structural barrier against self-sabotaging impulses that often surface in the heat of a live market. Look down at your fully completed 5-step zone trading checklist. By documenting these 5 steps, you have moved your trade logic from an internal emotional state to an external objective process. You are no longer reacting to price movement, you are managing a predetermined plan. Here is your ultimate litmus test. If your stop loss hits today and you feel completely emotionally neutral about the outcome, your mental analysis system is working perfectly. I challenge you to print this checklist and commit to using it for your exact next 20 trades. Do that, and you'll put yourself on the path to joining the top 10% of disciplined traders. If you found this system helpful, subscribe to the channel and share this video with a trader who needs to hear it.